The next industry we're going to look at is the automotive industry, which includes Advanced Auto Parts, O'Reilly Automotive, Lithia Motors, CarMax, and Copart. All these companies supply aftermarket parts, in particular Advanced Auto and O'Reilly. But Lithia Motors and CarMax also sell new or used vehicles, while Copart is unique in that it provides services that process and sell salvaged vehicles, in particular to insurance companies. Next is the liquidity ratios. You may notice that this industry has a lower current ratio than the other industry, with it being closer to 1 than the 2 than it was with the other industry. Though CarMax is unusually high by the industry standard, and Copart has made significant change in the last year from 2014 to 2015 in its assets. Next is the quick ratio, which gets rid of inventory. As you may notice, most of these industries drop significantly, with the exception of Copart, which has risen significantly in the past year. Then finally the cash ratio, which indicates where Copart has put all of its assets. It has significantly increased its cash in the last 2014 or 2015, which indicates that this company will be able to pay off any unexpected debt that may come its way short term, while other companies like Lithia Motors would have significant problems trying to pay off any unexpected debt. Next is leverage, which is actually much higher than the other industry, almost twice as high. Copart is particularly low for this industry, and overall the industry appears to be rising, though Advanced Auto has fallen in recent times. For debt capacity, despite having twice as much leverage in this industry, they also are like 2 to 3 times more capable of paying off such leverage. So the higher leverage is not really a concern, except for lithium motors, because they are unusually low and will have problems if they have too much leverage. Next is tax burden, which is part of the profit margin, tax burden, interest burden, and operating margin. The tax burden is a little bit more widespread in recent years and relative to the other industry, with relative stability in recent years, though. After 2012 to 2013, it stabilizes again. Interest burden is relatively standard and unchanging. Operating margin has a bit more variety in it, with Copart being unusually high for the industry, and the industry overall is fairly spread out. Next is profit margin, which is those 3 ratios together. Copart again is unusually high for the industry, followed by O'Reilly, and Lithia Motors is at the bottom again. Asset efficiency. Lithia Motors has significant advantage over the rest of the industry in terms of asset turnover. This means the company moves through assets at a much quicker rate than the other companies, like Copart, who moves through assets at a very slow pace. Next is ROA. Copart was high for a long time, but has in recent years fallen to be below O'Reilly, which is on a steady rise, while the rest of the industry appears to be on a decline or has stabilized. ROE, return on equity. O'Reilly has just risen up above everyone else, while Advanced Auto has done the exact opposite, falling, while other companies like Lithia Motors and CarMax have remained relatively stable and given a slight increase. Next is PE ratio. O'Reilly is the highest again, and Lithium Motors is falling to the bottom again with significant amount underneath everyone else, the industry standard. Next is the market to book ratio. O'Reilly is once again higher, and the others are relatively stable with only slight fluctuations. Next is EVA. All of them are positive except for CarMax, and of them all, O'Reilly is the highest. So the industry favorite is O'Reilly. It has average leverage for industry standard. Its time interest earned, however, is very high, capable of paying back its leverage almost 30 times. Its operation margin and profit margin are very high, indicating that it has a good manager. Its ROA is high, its ROE is the highest, its PE ratio and market book ratios are also the highest, and it also has the highest EVA. Finally, this is the comparison between the top two companies, Home Depot versus O'Reilly. I have the current ratio, equity multiplier, times interest earned ratio, asset turnover, profit margin, ROA and ROE. Of these, Home Depot is superior to O'Reilly in current ratio and asset turnover, meaning that it is better able to pay off its short-term debts and moves through inventory more quickly, its assets more quickly. O'Reilly, on the other hand, excels at the rest of that, though ROA and ROE, it's only just slightly more. You have to go out to the third decimal to find any difference. However, the reason why I like O'Reilly for the best company overall is its ability to afford its debt. So in the future, even though it's very close to Home Depot, it has the capability to expand much farther than what Home Depot could. Alright, that's it. Thanks for watching.